So, you want to own a gold mine. It sounds almost mythical. Dig into the earth. Find gold. Sell gold. Get rich. That's the story we've been telling for thousands of years. It's the reason gold mining is still romanticized more than almost any other industry. But here's what almost nobody realizes. The gold isn't really the business. The gold is the output. The actual business is moving unimaginable quantities of ordinary rock at extraordinary cost on the bet that a tiny, almost invisible fraction of it contains something valuable. A modern gold mine can process tens of thousands of tons of rock every single day. And after all that crushing, hauling, grinding, and chemical processing, the amount of gold recovered from each ton can be measured in grams or less. The overwhelming majority of everything you dig up is worthless. You're not really running a gold company. You're running one of the most expensive filtration systems on Earth. And that sounds logical. Until you look at the numbers. Because once you understand what those numbers are actually measuring, you start to see something strange. Even smart, well-funded companies can lose enormous amounts of money in an industry where the product itself is famous for holding its value. So, what does it actually take to make a gold mine profitable? Part 1. The illusion. The illusion is simple. Gold is valuable. Therefore, a gold mine must be valuable. But that's not how mining economics works. The price of gold doesn't determine whether a mine makes money. The relationship between gold price and extraction cost does. A mine can sit on billions of dollars worth of gold and still be a terrible business if it costs almost as much to extract that gold as the gold is worth. That's why mining companies don't obsess over the amount of gold sitting underground. They obsess over something called all-in sustaining cost, or AISC. It's a broader measure of what it costs to produce and sustain an ounce of gold, including mining, processing, administration, sustaining capital, exploration, and other ongoing costs. For many established operations, AISC can run well above $1,000 per ounce, and difficult mines can be significantly more expensive. Now imagine gold is selling for $2,000 an ounce. A mine producing at $1,300 has a very different economic profile from one producing at $1,800. Same product, same market price, completely different business. And that's the key. The real business isn't simply finding gold. It's controlling the cost of producing each ounce faster than the market can squeeze your margin. And that's where everything changes. Part 2. The cost of getting started. Before a single ounce of gold is ever poured, a mine can consume a decade or more and hundreds of millions of dollars. And there is still a very real possibility that it produces nothing. It starts with exploration. Companies drill core samples across a prospective site, trying to answer one fundamental question. Is there enough economically recoverable gold here to justify building a mine? That sounds straightforward. It isn't. Thousands of exploration projects compete for capital, and only a small fraction ever become producing mines. If the geology looks promising, the company moves into feasibility studies, environmental assessments, engineering, financing, and permitting. And every one of those steps costs money. Permitting can take years, depending on the country and the complexity of the project. A modern mine may need to satisfy regulations covering water use, waste management, tailings storage, wildlife, emissions, land disturbance, worker safety, and community agreements. And all of this happens before serious production begins. Then comes construction. A mid-sized open-pit gold mine can require hundreds of millions, or well over $1 billion, in upfront capital. You're paying for the pit, the processing plant, roads, power infrastructure, water systems, tailings storage, heavy equipment, worker facilities, and in extremely remote locations, sometimes an entire support infrastructure that looks more like a small town than a mine. And here's the catch. A company might successfully raise money for exploration, only to discover that it can't raise enough money to actually build the mine. So the deposit sits there. Proven. Permitted, perhaps. Economically interesting, but completely unproductive. Another project joins the graveyard of deposits that looked valuable on paper, but never became operating mines. Part 3. How the money actually flows. So, where does the money come from? The obvious answer is gold. Once the mine is operating, the primary revenue comes from selling the refined metal at market-linked prices, often through refiners, traders, or long-term offtake arrangements. But gold isn't always the only thing coming out of the ground. Many deposits contain other valuable metals: silver, copper, zinc. And when those metals can be recovered economically, they create byproduct revenue. That revenue can offset part of the mine's operating costs, effectively lowering the net cost of producing the gold. Then there's another layer most people never see: hedging. A mining company can use contracts to lock in prices for some of its future gold production. Why would a company sell gold before it's even mined? Because certainty has value. A mine financed with hundreds of millions of dollars in debt can't afford to discover that a sudden collapse in gold prices has made it impossible to service its loans. Hedging can sacrifice some potential upside in exchange for more predictable cash flow. And then there's one of the industry's strangest financing mechanisms: royalties and streaming agreements. A mining company can receive cash today in exchange for giving another company the right to receive a portion of its future production or a share of future revenue. The mine gets capital. The royalty or streaming company gets exposure to future metal production without having to operate the mine itself. It's a completely different way of financing a gold mine. And it reveals something important. The economics of a gold mine aren't just about geology. They're also about finance. Part 4. The hidden costs. Now comes the part that destroys optimistic mining models. The hidden costs. First, ore grades decline. A mine doesn't contain one perfectly uniform block of gold. Some areas are richer. Some are poorer. Companies often target the most attractive ore first. Over time, the average grade can decline, meaning the mine has to process more rock to produce the same amount of gold. And that creates a dangerous combination. Less gold per ton, but roughly the same machinery, workforce, infrastructure, and energy requirements. Then there's energy. Crushing and grinding rock into extremely fine material can consume enormous amounts of power. In some operations, energy represents a major portion of total operating costs. And then there's water. Mining requires water for processing, dust control, cooling, and other operations. In arid regions, simply securing and managing that water can become a major engineering and financial challenge. But perhaps the most important environmental cost is something called tailings. After the valuable minerals are extracted, you're left with enormous quantities of processed rock and waste material. That material has to go somewhere. And the storage facilities have to remain stable not just while the mine operates, but potentially for decades after it closes. A tailings failure can become a financial, environmental, and human catastrophe. And then there's the bill that arrives at the end. Mine closure and reclamation. The mine eventually has to close. Land has to be rehabilitated. Infrastructure may have to be removed. Water may need to be treated. Waste facilities have to be monitored. And governments increasingly require companies to financially plan for those obligations before production even begins. Then add currency risk, political risk, tax changes, royalty changes, permitting delays, labor costs, fuel prices, and inflation. Suddenly, that seemingly simple equation, gold price minus mining cost equals profit, isn't so simple anymore. Part 5. The economic engine. This is where the real business finally reveals itself. Gold mining operates on one unforgiving principle: fixed costs against a declining, depleting asset. Unlike a factory, which can theoretically operate indefinitely if demand remains strong, a mine has a finite resource. Every ounce you extract is one less ounce remaining underground. Eventually, the mine runs out. That means the entire economic model is a race against three enemies: depletion, grade decline, and cost inflation. The mines that thrive aren't necessarily the ones with the most gold. They're the ones that can produce each ounce at a low enough cost relative to the market price. That's the number that matters. Imagine two mines operating in the same gold market. Mine A produces an ounce for $1,000. Mine B produces an ounce for $1,800. If gold sells for $2,000, both mines are technically profitable. But Mine A has a massive cushion. Mine B has almost none. Now imagine gold falls to $1,700. Mine A can still survive. Mine B is suddenly underwater. This is why major mining companies obsess over their position on the cost curve. In a commodity business, you don't control the selling price. You don't control the global gold market. You don't control what investors, central banks, or geopolitical events will do next. But you can control, or at least influence, your cost structure. And that is one of the few levers you actually have. So that's the real business. Not gold. Cost discipline. Against a depleting clock. While selling into a price you can never fully control. Part 6. The psychology. So why does gold demand remain so resilient through recessions, wars, inflation, and currency crises? Because gold occupies a strange psychological position. It's both a luxury asset and a fear asset. Central banks buy it as a reserve asset. Investors buy it when they lose confidence in currencies or financial markets. And jewelry demand, particularly in major Asian markets, is deeply connected to cultural traditions, wealth preservation, and status. That makes gold demand different from many industrial commodities. But there's another reason investors are attracted to gold mining companies instead of simply buying gold. It's called leverage to the gold price. Imagine a mine producing gold for $1,300 an ounce. If gold sells for $1,500, the operating margin is roughly $200. But if gold rises to $1,800, that margin becomes roughly $500. The gold price didn't rise by 33%. But the operating margin rose by 150%. That's the appeal. A relatively small move in the gold price can create a much larger percentage change in a miner's margins. Of course, the reverse is also true. That's where investors get hurt. And mining companies make the same mistake. Again and again. They become too optimistic about future production. They underestimate construction costs. They overestimate ore grades. They assume everything will go according to plan. Then reality arrives. And reality is usually much more expensive than the feasibility study suggested. Part 7. Real failures. We've seen this story play out before. Take Pascua-Lama, the massive gold and silver project on the border of Chile and Argentina. The project became infamous for escalating costs, regulatory problems, environmental disputes, and community opposition. Billions of dollars were committed. Construction progressed. And yet the project never reached commercial production. It's one of mining's most powerful reminders that having a giant deposit doesn't mean you have a viable mine. Then there's Bre-X. In the 1990s, the Canadian company claimed to have discovered one of the world's largest gold deposits in Indonesia. Investors went wild. The company's market value exploded into the billions. There was just one problem. The gold samples had been fraudulently manipulated. When the truth emerged, the stock collapsed. The supposed fortune disappeared. And the episode became one of the most infamous mining scandals in modern history. It taught investors a brutal lesson. A gold estimate is only as trustworthy as the process used to verify it. And then there are the less dramatic failures. Mines built when gold prices were extremely high. Projects designed around optimistic assumptions. Operations dependent on unusually rich ore. Then prices fall. Costs rise. Margins disappear. And suddenly, a mine that looked brilliant on a spreadsheet becomes an expensive liability. Every one of these failures teaches the same lesson from a different angle. Mining punishes optimism. It rewards verification, conservative assumptions, and relentless cost control. Part 8. The math. Let's put the business into numbers. Imagine a mid-sized gold mine producing 200,000 ounces per year. Suppose its all-in sustaining cost is $1,300 per ounce, and gold is selling for $2,000 an ounce. That's a theoretical margin of $700 per ounce. Multiply that by 200,000 ounces, and you get $140 million in annual operating margin before corporate overhead, taxes, interest, and other adjustments. Sounds fantastic. But now remember what it took to get there. Imagine the mine cost $1.2 billion to build. Now subtract royalties, taxes, corporate expenses, interest on debt, sustaining capital, and all the other costs that don't disappear simply because the mine is producing gold. That $140 million headline margin can shrink dramatically before it becomes actual shareholder profit. And this is where mining becomes extremely sensitive to price changes. Suppose gold falls by 10%. $2,000 becomes $1,800. At the same time, operating costs rise by 10%. $1,300 becomes $1,430. The margin falls from $700 to just $370 per ounce. That's almost a 47% reduction in the margin from a 10% move in each direction. And that's the leverage. It works beautifully when prices rise, and brutally when they fall, which is exactly why cost control, financing structure, and hedging decisions aren't optional extras. They're survival mechanisms. Part 9. Best case versus worst case. In the best case scenario, everything lines up. The deposit has consistent, well-understood ore grades. Construction stays on budget. Permits arrive on schedule. The mine operates in a politically stable jurisdiction. Energy and labor costs remain manageable. Byproduct metals provide additional revenue. And then, just as production ramps up, gold prices rise. The mine generates strong cash flow. Capital gets paid back. Debt gets reduced. And the operation continues producing profitable ounces for years. That's the dream. Now consider the opposite. Construction costs explode. The mine takes longer to build. Actual ore grades come in below expectations. Recovery rates disappoint. Energy prices rise. Labor costs increase. Political tensions escalate. Royalties go up. And then, just as the mine finally reaches full production, gold prices fall. The same deposit that looked like a billion-dollar opportunity can suddenly become a barely viable operation. Or worse, it can fail to recover its initial investment at all. And here's the strangest part. The gold underground hasn't changed. The economics around it have. That's the entire game. Part 10. The real business. Because in the end, you were never really buying a gold mine. You were buying a very expensive, slowly depleting machine. A machine that converts rock, energy, water, labor, capital, and time into a tiny stream of refined metal. A machine racing against its own depletion. While the price of what it produces is determined by a global market you don't control. And that is why owning a gold mine is nothing like simply owning gold. When you buy gold, you own the metal. When you buy a gold mine, you own the economics behind the metal. You own the geology, the machinery, the permits, the workforce, the debt, the environmental obligations, the political risk, the cost structure, and ultimately, the ticking clock of depletion. The gold may be worth billions, but if it costs billions to extract, the gold in the ground doesn't make you rich. The margin does. And whether that machine makes you a fortune, or quietly buries one, depends entirely on whether you understood the economics buried beneath the ore, long before the first ounce was ever poured.